Alright, what's good, y'all? This is your boy Jay Devar bringing y'all another video. And in this video, I'm actually going to be going over the trade that I took on gold this morning at around, I want to say like 8:50. But yeah, today is March 2nd, 2023, Thursday. So yeah, I just want to run you guys through what I was thinking while I was trading gold and why I went through with the trade idea that I went through. Uh, and I'm going to be using the ICT concepts that I've been learning over the past few months to a year. So, uh, without further ado, we're going to go ahead and get into it. But before we get into that, I would ask that you guys please like and also subscribe to the channel and feel free to turn on the notification bell. So, that being said, let's go ahead and dive into it. So, as you can see right here, I have two charts up. My trading view right here is the US dollar index, the currency index, so the DXY. This is the daily for that chart, and on this side over here we have gold, right? The daily for gold. So, what I was thinking, or what I was analyzing, was that you see right here we have this buy side liquidity pool, this daily buy side liquidity pool right here, or basically this single daily high right here. So I'm anticipating this area right here to basically like the next couple of days or so, if not today, well, if not this week, maybe next week, because we only have tomorrow's Friday, and so yeah, tomorrow's Friday. I'm guessing that by tomorrow, Friday, we'll go ahead and like clear out this liquidity pool right here, and also tap into this daily volume imbalance level right here. So we're gonna treat this as a resistance level or a ceiling to end the week out. Um, if there's a day for it to actually run this high and tap into this volume imbalance, tomorrow, Friday, March 3rd, would be it. And then from there on, we have to see what goes on next week. So, something to note in the past couple of days that's been going on is you see right here, this little area right here I have marked out on the daily on the dollar. You can see right here, there's also another daily volume imbalance in this area right here. All right, so this was formed last Wednesday, the 22nd of February. So this was formed last Wednesday. And as you can see, yesterday, Wednesday the 1st, March 1st, it came down and tapped into this area and delivered here perfectly. So as you can see, it's like nice little clean sweep or clean touch right in here. It didn't even right here. So exactly, if I was to line it up exactly, you see beautiful precision, perfect precision right here. So it came, tapped into the daily volume imbalance, and started to head higher, right? You know, it just came here and wicked, and the price just did its thing from here on out, or the algorithm did its thing from here on out. And as you can see, Thursday, ever since tapping into this area yesterday, Thursday, we've just been completely bullish, and also that's due to the fact of and we also had like a news catalyst come out today, Thursday at around 8:30, which was the U.S. The unemployment claims for the dollar, and this report actually came back pretty positive. Um, it, if you didn't know, as you should know, at this point in time, the government basically there, or the Fed, they're fighting against inflation at this point in time. So any type of economic data that shows that like the economy is slowing down, is basically going to be some good news for the dollar, right? It's basically going to be some good news for the dollar. Um, Although unemployment claims aren't necessarily like a high impact news event, as you can see the color of the folder right here, it's a medium impact news event. So, but in this case right here, this economic event right here specifically, as you can see, actual less than the forecast is good for the currency. So this is actually good news for the dollar right now. So that's why we started to see higher prices today when this news report came out. And I'm actually going to show you what happened at exactly this time as this report came out. And I'll also show it in gold also. So, all right, so that's basically it for the dollar. Now I'm gonna go over to the weekly time frame. So note these levels right here that I have marked on the on gold right here. So as you can see, well, this is gold, but this is the dollar. So note this daily volume imbalance level right here that got tapped into yesterday. As you can see right here, Wednesday, the 1st, Wednesday, we actually on gold. Now we're looking at gold now. So on the daily here, on gold, yesterday we formed a fair value gap in this area right here. So we formed this is a daily fair value gap that was formed as of yesterday's trading. So yesterday's volume imbalance trigger here on the US dollar. Yeah, so yesterday's volume imbalance here, right? So that basically this candle right here. So basically yesterday being a bearish day in the market, in order to drive price down into this daily volume imbalance level right here, that resulted in a bullish day on gold yesterday to not only form this fair value gap, but also tap into the consequent encroachment of the this daily wick that we had a couple of days ago, last week, right here. So note right here, February 22nd on the daily, my bad, on the dollar, and also too February 22nd of this this large, basically large range day right here, this huge bullish day right here, right? That also formed this wick, and we formed this consequent encroachment of this level. Basically, all I did was take a Fibonacci tool, take it from the high of the wick, and bring it down to the close, no, the open of this specific candle right here. That's this candle. So from the high of the wick to the open of the actual candle, right? And then from there we take the 50% level of that, and that's the consequent encroachment level right here. I can do a separate video about that later. That's something that ICT is the inner circle trader Michael Hudson has been teaching us in his mentorship this year. He started teaching it a couple months ago. So yeah, as you can see right here, so the consequent encroachment of this large candle right here from last Wednesday. This Wednesday, yesterday, the Wednesday of March 1st, it actually came here and tapped into the consequent encroachment of last Wednesday's candle wick right here. So you see, came up, went through it, and actually it had a pretty good reaction off of this level right here, the consequent encroachment of this midway point of this large wick right here. And as you can see, we came down, and next day's open, we came over to this area, and this is where we started having a bullish day right here. So I'm also note this also, if you didn't know, as a new trader, basically gold and the dollar basically have an inverse relationship, because you can see the pair for gold is, or the ticker for gold is XAU USD. So this is gold versus the dollar. So if you put like a little hyphen here, this is like gold versus the dollar. So generally, this is gonna have a inverse relationship. Gold is gonna have an inverse relationship with the actual dollar, because it's being basically weighed against it. So the days where you see the dollar is having a, say, bearish day, a lot of the times gold is going to be responding to that inversely. So where the dollar is being bearish, gold is usually rallying. So that's actually gonna that very specific sorry, I'm stuttering, but that very specific inverse relationship is exactly why I was able to capitalize on the trade that I took today. So that's enough on the daily time frame. So now we're gonna go down to the hourly. Before we do that, just note right here that, like, in the next coming days, or possibly next week, you guys remember where I said that possibly next week or maybe even tomorrow we're gonna eventually head for that buy side liquidity pool on the daily time frame for the US dollar, and also too back into that volume imbalance right there. I treat these volume imbalances as like real support and resistance levels, because this is basically void of like any trading per se. You see, it tapped into here like last year in December, and it hasn't been revisited back since. But this is an area that I'm highlighting and keeping note of because I'm anticipating some type of reaction out of here. If it trades through it, you have to wait and see then. But as far as right now, the immediate reaction that I'm anticipating is like there's a buy side liquidity pool here. And there's also this volume imbalance level here. So this is basically two forms of a confluence to signal a potential run lower to some area in here. Not saying all the way down here, but some type of run lower down back into this level, into this area here. But as of right now, I'm anticipating higher prices in the dollar to come and tap into this area and then have a reaction to the downside. And also inversely, what that means for gold is like as this rises, as the dollar rises to take out this liquidity pool, gold is most likely gonna be selling off down into this daily fair value gap that I have marked out right here, right? So that's the idea, the long-term idea later on down the road that I have mapped out. So that's what I'm keeping note of over the next couple of days and going into next week. So that being said, we're going to go down to the 1 hour time frame. So the 1 hour time frame, we also have a 1 hour fair value gap right here on gold. I had this level marked out right here because I was thinking this is possibly an area we could end up returning back to, possibly later on today. This was formed Tuesday, this past Tuesday this week. This fair value gap was formed right here on that 1 hour time frame. So could we have traded here today? Yes, we could have. And also, even at the time we recorded this video, it's only 1 o'clock, like 1:30. So it potentially can still trade into this area at the end of the day. We won't know for sure until the end of the day. At 5 o'clock p.m., that's when the New York time is over. New York session is over, basically. But in the meantime, so right here, didn't really have anything marked on the 1 hour time frame here, but the only thing I can really note is that we have this order block right here. We have this 1 hour order block right here. Actually, I'm gonna leave that replay. All right, I'm gonna leave that. Just mark this as like a bullish order block. And we're just gonna leave the fair value gap alone because that was a fair value gap on like daily time frame. So you're just gonna do that. So as you guys can see on the daily, it actually came and tapped into this 1 hour fair value, this 1 hour order block, bullish order block, and also into this fair value gap level that's been marked right here also. I want to say this is actually on the lower time frame. I usually mark them out. I didn't do it this time, but hey, as we review it, it'll make more sense. But so noted today, I had these times mapped out. This is the time where I trade the New York session kill zone, basically from 7 a.m. to 10 a.m. I have this marked out because this is the time window that I'm working through. So if I see anything that forms that I like for like the price pattern that I've learned from ICT, if anything forms in this this time frame, that's when I'm looking to take it, right? So right here on gold, 7 a.m. to 10 a.m. right here, same thing. So as I said, this 1 hour order block right here, game tap, fair value gap, possibly on the lower time frame, we have a reaction. Price is heading higher. And inversely, for gold, it was heading lower. So originally on gold, this is what I had mapped out. I was anticipating the sell side liquidity or the high time frame low right here to actually be taken out. Because right here, this is where sell stops are resting. And if I was to take it over here, you'll see that like there's some relatively equal lows right here, so like a double bottom right here, and then there's also a fair value gap also resting right here. I'm not going to mark it out, but you can clearly see it plain as day. I'm actually going to move this over to the right so it's a lot more cleaner so you can see better. So right here we have relative equal lows. Originally I was anticipating price to head lower, right? I was anticipating price to actually run this sell side liquidity pool and actually continue lower, possibly tapping into either this 1 hour fair value gap or revisiting this 1 hour fair value gap right here. Just gonna mark it out. I'm not gonna make it perfect, but potentially digging back into this area again, because fair value gaps can be basically you treat fair value gaps as like real support and resistance. So anytime you note a fair value gap, if it gets traded through, you treat it as a resistance. If it but in this case, with it coming down here, this is support. So I would have treated this as, so I was looking to treat this as actual support. If it did, you know, go below the sell side liquidity pool, or go below this, basically the sell side liquidity, tap into it. If there was any type of reaction I was looking for, I would look for it in here. However, it actually didn't end up coming down that low, right? It actually didn't end up coming down that low. But although I still did like the trade idea enough to still go ahead and take it. So now we're going to go down to the 15 minutes. And on the 15-minute time frame right here, this is where I use the Asian session range. So we have the midpoint of yesterday's Asian session range. My specific parameters are 5 p.m. to 1 o'clock in the morning. Now you see right here, 1 o'clock in the morning, the low that was formed yesterday or last night on Wednesday the 1st was at 8:15. Right, so that low was taken out at around the London session open, so 2 o'clock in the morning in New York time. So basically, the reason why I use the Asian session range is because it usually forms the next day's first higher low of the day. Right, so in this case, the range right here, this is the high at the close. Gold's close on gold's market open is 6 a.m. Not 6 a.m. 6 p.m. So right here, this high is the start of the Asian session in New York time for the gold market. This low was the last low that was formed at the end of basically the Asian session going into the London session in like the next hour. So this was the first next day's high and low after the New York session, after the New York close. So the reason why I use this is because basically the same thing. There's liquidity here in this range. So normally what happens with the Asian session range is whatever gets violated first, like if the high or the low, whichever one gets violated first, generally there's the reaction in the opposite direction to target and form, the new day's high, and then continue on from there, maybe either into another previous high from last week or another day, or basically continue and head lower. But that also depends on like what kind of like economic news drivers are out there this week. With today being Thursday, really shouldn't expect too much of a movement today, except within the range right here that we have right here, because like I said, like there's no economic news drivers out right now, and tomorrow there's really nothing going on either. So really you just expect for the markets to be consolidating and possibly just continuing in whatever direction they're going, or working within smaller ranges. In this case, gold's Asian range right here, this is where it's been trading. So right here we formed the second day's low, the new low for the day, right? The new low for the day, right? which is right here. So the whole time I was anticipating the buy side liquidity or the high to be taken out today here, and it finally did do that at around this candle right here, which is at 10 o'clock, exactly 10 o'clock, and did it again at 10:30. But so the reason why I took a buy setup is because, again, um, the buy model that's set up for the fair value gap entry, the buy model is you generally want to see a low, some type of low or some type of liquidity pool, or like some type of like PD array at the bottom. You want to see that get tapped into, or you want to see some sell side liquidity get ran or triggered. And then normally what happens is the opposite occurs, where retail traders would think that, okay, we're breaking below a low, so now we're going to continue lower. They try to trade the breakout of that, but they're actually getting stuck, and now their stops are getting hit. And basically what happens is the algorithm, or the big banks, whoever you want to believe in, they actually do the opposite. So they have sellers here, or they have the lower price that they want, the discounted price that they want. So now they start raising the price and racking up buy orders and bringing in more buyers, so they can basically make their money, right? So that being said, I wasn't really paying too much attention to it on the dollar, because I mean, it's the dollar, you know. The only reason I'm looking at the dollar is just for the inverse relationship of gold. So now we're gonna go down to the 5-minute time frame. I generally don't like to look at the 5-minute time frame because it never really forms anything that looks, you know, really clean. So I normally go to the 3-minute or the 1. But as we go down to the lower time frames, you see right here we have a fair value gap on the 5-minute of the dollar chart right here. So there's a fair value gap right here. Came back down, tapped into this area at around 10:50. So I was already done trading by then, but that was a level that it was likely to refer back to, which it did. But in the actual time, I was trading right here, right? Also, too, I have the 8:30 time marked right here because I also wanted to show you too what happened exactly at 8:30. So pay attention to the 8:30 candle open on the dollar and the 8:30 candle open on gold. At 8:30, right? Well, I also said at 8:30 right here, 8:30 a.m. unemployment claims, right? These numbers turned out to be good for the currency. So what happened? The dollar started to rally. And inversely, what happened on gold? Started selling off. That's the only reason why I have this chart over here with me while I'm trading gold. It's because, you know, as I mentioned before, they have this inverse relationship, right? So now we're actually going to start getting into the actual trade idea, right? So as I was watching price from 7 to about 8:57, where I actually entered, right? So as I was watching price, I noted on gold this 5-minute fair value gap right here, or this 5-hour basically bullish fair value gap right here, because all these bullish candles right here in this fair value gap form right here, I was anticipating. Actually, I was just watching price as it formed. This fair value gap right here actually ended up getting traded through, right? So when that happens, ICT, Inner Circle Trader, he taught us to basically treat these as real support and resistance. So although this fair value gap may fail to the bullish side, you know, you can also use it as support when it breaks through the low of the fair value gap right here. You can use it as support, right? And that's exactly what happened here. It started tapping, price started tapping into the bottom of this fair value gap right here, and down into this fair value gap that's resting right here. And this fair value gap has also been tested several times actually, which is why I was anticipating for it to like really fail, right? For it to like really fail and head lower, because normally when a level gets tapped into a bunch of times, it actually normally starts to get weaker there. So in this case, we tap 1, 2, 3, 4, 5 times. Right? So I was anticipating the level to be taken out. However, that wasn't the case. So uh, I'm just going off of what I was reading. So in this case, price was really showing like heavy resistance, or like just it was refusing to head lower below this fair value gap, because every candle that came here never really fully closed except for right here, but it still rallied higher and actually broke this high. But every candle after that, just came and wicked, came and wicked, came and wicked. There never was a close below. So this tells me that this is a level that is just has so much respect right here. Right, so this is a key level, which is also why I have it marked as like a little golden zone right here. So, as I said, there was sell side liquidity here. There's also a sell side liquidity pool that's resting right here. I can go ahead and mark this out really quick. Shift. Basically like a low. It's a single low right here. So this low was ran. And basically now I'm getting into showing you what exactly I was looking at, or what I was looking at, and why I got into the trade. So coming down right here to the 1 minute time frame, you can see we have these relative equal lows right here on the 1 minute. This is that 5 minute low that I just marked earlier, right here, the sell side liquidity pool. So there's these relative equal lows right here on the 1 minute time frame, right? So price came down, triggered it, right? And right here, I was expecting it to head lower and tap into this area, and then possibly wait for the setup here. However, that's not what happened. Actually, when price came here for gold and tapped into the area, or triggered the sell side liquidity, or these lows right here, right? Because there's orders resting right here. You see, we started to rally up strongly. And this is a 3 candlestick pattern that ICT taught us before, or that I've learned from ICT before. So normally when you see a run like this, a 3 candle run like this generally indicates a shift in market structure. And that's exactly what happened right here. All right, so I'm gonna mark it out right here. This high was taken out right here. This previous high, or this previous lower high, was taken out with this bullish run right here. So this right here alone indicates a shift in market structure, right? On top of that, we also have a bullish breaker that was formed right here. So the breaker I decided to use was this candle right here, this bullish candle right here. What would have been a bearish order block. Instead, it's a breaker, because here we ran some sell side liquidity and also made a run above an old high, right? So this is why this is a bullish breaker. So not only that, but also too, we have a fair value gap right here. Boom, right there. Hold on, let me change that. Fair value gap. Boom. And this was my entry right here. This candle right here, I had a limit order right here. This is on a paper trading, right? So I took this paper trade right here because I'm currently paper trading right now. No shame in that at all. But my limit order was set at the top of this fair value gap right here. That's why I have this set up right here, because this basically framed my idea, right? It was a 1 to 1.3. Well, it was a 1 to basically 1.3. So a little bit above like a 1 to 1. I normally don't take setups like this. I normally want to see like a 1 to 2 or 1 to 3. But from this specific level right here that I entered at, right, it was a 1 to 3. Now, I did have it in my mind of like wanting to take the entry here, but I wasn't sure if it was going to end up here. So generally what ICT teaches us is, when you have two fair value gaps form back to back, generally you can sacrifice the lower one right here, because there's another fair value gap right here, right? So generally, if you want to go ahead and get in, you can basically sacrifice this entry right here, because this is the more precise entry. But more often times than not, it'll come and tap into this fair value gap right here and rally off. So if my order is resting here, it won't get filled a lot of the times. So if I just wanted to get in the trade, then this is the one I would take, and I just set up the proper risk. So in this case, the stop loss would go below this low right here, right? And I just had it to the sell side liquidity of the actual low, like the London low that was formed. So I had it resting below there, right? But in this case, it actually came, and I thought about re-entering in again, and I honestly tried to, because I knew this was going to be the better risk to reward setup. But I just couldn't. I made too many mistakes of like trying to set the limit orders and the the stop order and all that. But if I would have been able to get in here, I would have had two trades going. So this one right here, I was risking $1,000 for a return of $1,300, because it's a 1 to 1.3. So you add an extra $300. So this one ended up being a 1 to 3. This fair value got right here. If I could have got in right here, this trade setup, this one would have been use the same stop loss. This one, and basically my target or my take profit area was the buy side liquidity that was formed right here. So we have these two relative equal highs right here on the moment of time frame, right? So this right here, a rule of thumb, a thing that ICT teaches us is smooth edges like this want to be made jagged. And as you can see, that's exactly what happened. The buy side liquidity right here, these two relative equal highs right here, right? Price came, made a jagged. Smooth, jagged. Smooth, right? Smooth, jagged, right? So from here alone, this setup, if I could have got in, would have been 1 to 2.5. So I would have made double the money, or double my risk on this specific setup right here. However, like I said, I just made two mistakes and couldn't get the order filled in fast enough. So, but yeah, so that's the trade setup on gold. So now I'm gonna tell you, as this was going on, this is what was going on at the dollar. So I got in the trade at exactly 8:57 right here. At 8:57, this candle opened up right here and tapped into the fair value gap. So that triggered me in, right? You can see that's the execution arrow right there. You see the buy, right? And this was my exit, or basically my TP came here. So in a total of from 8:57 to 9:04, I was in this trade for 7 minutes to basically make $1,300 in demo profits. But it's practice. It's gonna be the real thing, in the next couple months. So so it's all about progress, people. All about progress. But so from 8:57 here on gold, we opened lower. 8:57 here on the dollar. As you can see, remember that inverse relationship right here. We opened up higher. Took out this high, and then right here, we started selling off right here. So I have this range marked out on the dollar, right? Because this is where I got in on gold at 8:57, on the dollar at 8:57 to basically 9:04 right here, right? So from 8:57 on the dollar to 9:04 on the dollar, the price of the dollar was basically falling. As a result, remember I said that inverse relationship from 8:57 to 9:04 on gold, right? So 9:04, 8:57, 8:57 to 9:04 on gold, we had a rally, right? That's the power of trading Pairs that have an inverse relationship. When one does one thing, the other generally does the other. So this right here is a powerful indicator in itself without having to have like RSIs or all that stuff, stochastics, blah blah blah. But this right here is a powerful tool in itself, right? Also, to note on the dollar, why I was anticipating a higher price on gold and why I thought this trade would be favorable for me was because on the dollar, right here at about 846, 847. So from here to here, right, this run right here, there's a right. So it takes out some liquidity right here on the dollar, or these little relative equal lows right here. Right, boom, you got that. Took that out, and then it did the opposite with that same three candlestick pattern I told you about. Usually this indicates a shift in market structure, which in this case it did. So right here, broke this high, right here, broke this high, or this previous high, this lower high right here. It broke that, and also it left a volume imbalance right here. Whenever I see a volume imbalance, this is an area that I pay a lot of attention to, and that I really anticipate like price or the algorithm to really make its way back to, right? Like areas like this is a magnet. So I'm anticipating this to be traded back to. We had a couple more here, but this one right here was actually void of any type of trading at all. So really, this isn't really a volume imbalance per se. I want to say this is more like a liquidity void, because there's no trading in here at all. As you can see right here, these two candlesticks right here, like this is a volume imbalance, right? Like there was activity that went on here. It's just that price hasn't made its way back to it yet. But there's activity that went on right here. Here, nothing happened. So the algorithm or price is going to want to be filled back in to fill in this void, right? So, which led to my trade idea actually panning out and working out, because I marked out this level as I was watching gold, the price of gold, right? So right here from, let's say, 846 to right 848, that volume imbalance right here that's formed, right? So from 846 to 848, that volume imbalance on the dollar was formed, and from, let's say, 846 on gold, 846 on gold to 848 on gold right here, 846, 848, 846, 848. We're rallying lower, right? So this whole move downward on gold, the whole time the dollar was hitting higher, because it created a shift in market structure and basically left this area unfilled. So I was anticipating whenever the dollar does start to cease and show another shift in market structure, which is what it did right here. So right here, it formed this higher high. All right, then it formed another higher high and ended up taking out this lower low right here, or this higher low right here. So this right here is a shift in market structure, right? So this right here is a shift, bearish shift in market structure for the dollar. Bearish, yeah, so bearish shift in market structure for the dollar leads to a bullish market shift in gold, right? So right here at 9 o'clock, that shift happened, headed lower down into this volume imbalance. Right here on gold at 9 o'clock, it was actually rallying and actually broke above and actually caused another shift in market structure. Or actually, this isn't a shift in market structure. This is actually like a breaker. This is a breaker block right here, right? So market was heading higher until ultimately, boom, we hit our TP on gold, and also too at that same time this volume imbalance was filled in, right? This volume imbalance right here was filled in at around the same time that we had our TP hit on gold, right? And honestly, from then and there, I was done, because I'm like, I still wanted this trade idea right here to pan out, because you see I have this level right here marked out. I was anticipating price to come back down, because there's a breaker, and then there's also another small little fair value gap right here. So I would have been perfectly fine wanting to take that idea. If it didn't necessarily reach TP here yet, I was gonna wait for it to come here and higher and have another trade idea. So like the entry right here, like the stop loss right here. So this would have been the trade idea. So from right there to ultimately right here, but I would have been sized down. So right here, I would have been risking about 0.5% of my total account value, because I already have like a high leverage position right here, a 1% trade going on right here. So I don't want to make it another 1% trade and then end up with like a 2% loss if it didn't pan out. But you can see, thankfully, everything worked out how it did. And yeah, it's just being sure to take note of the things that I was watching and applying the things that I've learned. And as you can see, we just had perfect execution. So yeah, eventually gold did end up returning back to this level later on in like the PM, the lunch session. So this trade idea would have panned out, but by that time I'm like, I already made the, I executed on a good trade. So I don't see the point in like, waiting here all day. And plus I didn't want to wait any longer, from 7 to 10, that's 3 hours there. So I would have had to wait an extra 2 hours before this trade actually triggered. And by that time I wasn't even looking at the market no more. So yeah, I was fully satisfied with this trade right here. It's typically not a trade I would take, but it still worked out. It was still a good trade. Nonetheless, it was still a good trade. At this time here, yeah, it was still a good trade. So I said, hey, I gotta take it. And hey, 1 for 1 isn't bad either. Although I want to aim for like 1 to 2, 1 to 3. But ICT tells us, at first, learn, just get in at first. Just get in, and then you can learn to hold your trades later. So, yeah, perfect execution. Right here, perfect execution. As a matter of fact, I'm going to go ahead and save this chart image right here and go to my trading journal, a Notion trading journal right here. I'll go ahead and see all my different setups right here. Alright, so I'm gonna do this, and then when it loads up, now I'm going to caption it. If it comes up, caption, gold trade breakdown. Gold trade breakdown 3/2/23. Yep. Oh, hold on. Gold 1 minute trade breakdown. There we go. All right, guys. There we have it. I do apologize if this video was like kind of long and drawn out. I just still trying to learn and get better at teaching what I've learned and showing it, putting it into action and applying it. So just bear with me. Besides, I mean, hey, it ain't gonna hurt you to listen to the whole video. I mean, hey, just watch it, man. Don't be lazy, But I do believe that I did my best to really put in like some valuable information in this video, and hopefully this actually helps somebody. So, yeah. But with that being said, y'all, like the video, subscribe to the channel, and yeah, y'all. Peace out. See y'all in the next one.